Good morning and welcome to the Williams-Mullen Annual Benefits Forum. My name is Marc Puritun and I'm the chair of the Employee Benefits and Executive Compensation Practice Group here at Williams-Mullen. I'm joined today by my colleagues Marie Yascko-Rosado, Nona Massengill, and Brydon DeWitt. While we are disappointed that we will not have an opportunity to be together in person this year, we still believe we have important topics and information to cover, and we hope that you find it useful in charting your course to recovery during these uncertain times. A few housekeeping points first. If you have any questions that you need to ask during the presentations, you can use the Q&A feature at the bottom of the screen and submit questions. We will be answering questions after each session, time permitting. If your questions are not answered during the presentation, we will reach out to you directly after the presentation. A copy of today's presentation will be emailed to you following the webinar. This program has been validated for 1.5 PDCs and SHRM CM credits. There's all kinds of letters there. I'll just say that it's going to get credits. All attendees will receive an email after this program regarding the active numbers and attendance verification documentation. Okay, so let's get started. The first presenter is Brydon DeWitt, and he's going to talk to us about employee benefits after furloughs and layoffs. Brydon.
Thank you, Mark, and good morning, everyone. Thank you for joining us in this rather different style of our annual Employee Benefits Forum. We're really thrilled that you were able to join us this morning virtually, and as Mark said, I wish we could be together, but we're glad that you're here. So my portion of the presentation, I'd like to talk about what happens when you have employees returning from furloughs and layoffs. And we chose a nautical theme for this year's benefits forum. And I'm not a sailor, I'm not an expert on nautical matters, but I can use Google. And I found this term tide over from the National Oceanic and Atmospheric Administration. And tide over is a nautical term, which means there's no wind to fill the sail. When there's no wind to fill the sails, sailors would float with the tide until the wind returned. They would tide over. And I thought during the COVID-19 crisis and the economic situation that we're in, we're kind of tiding over. We're waiting for the wind to fill the sails again. And when the wind does fill the sails, we will have employees who perhaps have been furloughed or employees who were laid off returning to service. And so I want to talk about specifically with respect to 401k plans and health and welfare benefits and cafeteria plans, some things to consider when you have employees returning to service. And these aren't necessarily new rules. Some of the concepts with the Affordable Care Act are a little nuanced and they're rather new. What's new is that for perhaps the first time or the first time in a long time, companies have had furloughs and layoffs, and those are, once the wind fills the sails, once the economy recovers, and we've already seen some recovery, employees will be returning to work. And so it's really a good moment to take a step back and look at some of the basics of what our plans provide, what the Internal Revenue Code and the regulations provide regarding computing service for employees under a 401k plan or for a qualified pension benefit plan. And so what I'm going to talk about are the rules that are allowed under the regulations. There are also certain choices that you can make that are then documented in your plan document. So I'm going to talk about what the law allows, but you also have to, for your own particular situation, need to know what your plan document says. So it's a good, if you haven't really been dealing with these issues before on a regular basis, now is a good time to pull out the plan document, and the summary plan descriptions, and really determine what those documents say, and what the rules are under your plan document that will apply to employees who are returning from a leave of absence, whether that's a furlough or a layoff. And for purposes of our discussion, and this is something if you've seen our communications on furloughs and layoffs, there isn't really a legal definition of what a furlough is or what a layoff is. But for our purposes, a furlough is where an employee's employment relationship with the employer has not been terminated. So this is where an employee's hours have been drastically reduced, perhaps reduced to zero, but they are on leave, most likely unpaid leave, due to the economic conditions. But they still are an employee. They haven't terminated employment with the employer. They don't have to be rehired. They just get their hours back. They're just brought back into active service. And so that's a furlough. The individual remains an employee of the employer during this period of time. A layoff, however, is where for our purposes, is where the employment relationship has ended. So the employee has been terminated from employment from the employer, with the anticipation that if conditions improve, the employee may be called back and rehired. But that employee, under our definition that we're using, would have to be rehired. We have to be onboarded back into the employer. That the laid off employee is no longer on the books as an employee of the employer. So with that kind of distinction in mind, let's go through first some of the service crediting rules that apply for eligibility for participation in a plan and vesting service for an employee who returns from a furlough or layoff. And again, as I said, let's go back to some of the basics and to refresh our understanding of how service is credited under a qualified plan. So first of all, under Code Section 410, a plan may not require more than 1 year of service to participate, unless the plan provides that after 2 years, an employee becomes fully vested in his or her employer contributions. So the general rule in almost every plan that I deal with is 1 year of service is the maximum amount of service that a plan can require an employee to complete before becoming eligible. A plan, however, again, may have a 2 year service requirement if after 2 years of service, the participant becomes fully vested in the employer matching contributions or profit sharing contributions, the employer non-elective contributions. And then as far as an entry date, once an employee completes the service requirement, the employee must be allowed into the plan no later than the earlier of the 6-month anniversary of the date the employee met the age and service requirements for plan participation, or the first day of the plan year beginning after the date on which the employee met the age and service requirements. So if an employee met the requirements in the second half of the year, you could allow them, you could wait until the first day of the next plan year to allow the employee to start participating, to start making elective deferrals. Many of the plans that we work with have earlier entry dates than semi-annual entry dates, but that's the minimum requirement under the Internal Revenue Code. And again, I need to emphasize, you need to look at your own plan documents. So I'm telling you what the law allows. Your plan may be more generous. Your plan may not, it may be that your plan doesn't require even a year of service. Your plan might allow all newly hired employees to participate immediately under the plan. So again, I can't emphasize enough that we really need to take what I'm saying in the context of your own plan document. So a plan generally cannot require more than 1 year of service for eligibility to participate. And so what is a year of service? So a year of service is a 12-month measurement period in which the employee is credited with at least 1,000 hours of service. Or if your plan uses the elapsed time method, it's based on the employee's period of service with the employer and not the specific hours worked. And so again, that's where you need to know your plan document and know whether your plan uses whether your plan actually counts hours to determine years of service, or whether your plan uses periods of service, 1 year periods of service under the elapsed time, the alternative method of computing service, the elapsed time method. And if you, so the next couple slides, I'm going to talk about the actual hours counting method, and you could tide over if your plan uses the elapsed time method and wait for me to talk about the elapsed time method. So the measurement period that we're talking about is for eligibility to participate is always the initial measurement period is the employee's first 12 months of service. So from the hire date to the anniversary date, you measure that period to determine whether the employee worked the 1,000 hours, earned a year of service in order to be eligible to participate. After that initial year, you could continue the plan. You have to look at your plan document. It could continue to use anniversary dates to compute years of service, but the plan can switch after that first 12-month period to the plan year and use that plan year as the ongoing measurement period, 12-month measurement period for determining years of service. Again, you have to look at your plan document. Most documents do switch from that anniversary date to the year of service, because otherwise you'd have a special rule, special anniversary dates for every employee, special measurement periods for every employee. So you need to check the plan document to know your measurement period. And then the plan should specify whether, how you define a break in service. And so under the regulations in the code, a measurement period during which the employee is not credited with more than 500 hours of service is a break in service. And that's a really important concept. If an employee, so for example, if the plan requires 1 year of service for eligibility, you don't have to count the service before a 1 year break in service. But if the employee is laid off and returns, and during the measurement period, the employee is credited with over 500 hours of service, the employee did not have a break in service. So you would have to count the pre-break service in that circumstance. So you need to know whether the employee has worked at least 500 hours or over 500 hours of service during the measurement period. If the employee does have a break in service, a 1 year break in service, the plan can treat that employee as a new hire and disregard the pre-break service. If the plan has that other rule, the special rule where you vest after 2 years of service and requires 2 years of service to participate, the pre-break service is counted after the employee has completed 1 year of pre-break service. But again, keep in mind, you know what your measurement periods are, and then measure the hours during those measurement periods. So with that in mind, with a plan that uses the actual hours method of computing service, and employees are returned from a layoff or furlough, you have to look at them and think, okay, were these employees laid off and rehired during the same 12-month measurement period? And so if they were, then you still look at that measurement period to determine whether they worked 1,000 hours during the measurement period. So even if they were laid off, if they were laid off and rehired, and it's still within the same plan year, you would then look at the hours they worked before they were laid off, the hours they worked after their return, if it was a really short-term layoff, and determine whether they worked 1,000 hours during that 12-month measurement period. If they did, then they earned a year of service under the plan. You could also look at whether the employee experienced a 1 year break in service during the layoff. Now, because of the COVID-19 crisis, if the layoff is purely related to COVID-19, you may not know that. You may not know whether the employee, or maybe if the employee worked 500 hours or more than 500 hours before the layoff during the current plan year, and the employee returns, then the employee would not have incurred a 1 year break in service. But you have to determine whether within your measurement period, the employee worked over 500 hours of service to determine whether there was a break in service, and then whether you can disregard service earned before the break in service. And then you have to, again, know whether the plan doesn't even care about hours of service and uses instead the elapsed time method. So with the elapsed time method, I don't know, maybe it's just the way my brain works. I always have to reread the regulations for the elapsed time method, because this is, if you think in terms of, we credit employees for the time that they work for us. We credit the hours they work. We credit them for service only when they are actually performing service, or if they're on a leave and they're entitled to payment. There are certain exceptions under the actual hours counting method. But we always think of service typically as, time the employee is actually employed, right? Well, the elapsed time method is a little different. So under the elapsed time method of crediting service, the hours worked really don't matter. The only hour really that matters is the first hour that the employee works for an employer. So under the elapsed time method of crediting service, service is taken into account from the date the employee first performs an hour of service until the date the employee severs from service. And so that entire period of time is counted. And then the 12-month periods, and those periods can be aggregated, that the employee works for the employer during that period of service from the date the employee first works an hour of service until the employee severs from service, are counted to determine 1-year periods of service that are used for eligibility and vesting purposes. So the date the employee starts work, that's easy. That's the date the employee first performs an hour of service. The date the employee severs from service is a little tricky. So that's the date that the employee either quits, is discharged, retires, or dies. And that's easy, we understand that. Or it's the first anniversary of the date the employee is absent from service for any other reason. The regulations use the term layoff, but really when the regulations use the term layoff, really what they're talking about is what we are calling a furlough, where the employment relationship has not ended. So if an employee is absent from work due to disability, vacation, leave of absence, or layoff, that does not result in a severance from service until the first anniversary of the date the furlough began. So even though the employee isn't actually performing services, and under the actual hours counting method, we wouldn't be crediting hours of service. Under the elapsed time method, for up to 12 months of a furlough, the employee is still treated as being credited with service. So that goes 12 months out from the date the furlough begins. If the employee is on furlough, it then quits or is terminated during a furlough, then that ends the employment relationship. And then the other interesting aspect of elapsed time is if an employee severs from service and is rehired within 12 months, the employee receives credit for the period of absence. So even though the employee was completely discharged from employment, if the employee returns within 12 months, that period between termination and rehire is credited as service under the elapsed time method. So I think the best way to think through this is to look at some examples. So in this first example, suppose an employee completed 6 months of service and was furloughed. The employee's on furlough for 2 months, and then the employee says, I have to find another job. The employee quits after 2 months on furlough. But then the employee, tied over ends, and the employee returns to service 5 months later. Now, I think if you weren't familiar with the elapsed time rules, you would think the employee would be credited with 6 months of service, where the employee was actually working. But under the elapsed time method, because this employee returned within 12 months, the employee is credited with 13 months of service. The employee had 8 months of service. That's the 6 months the employee was actively employed and the 2 months on furlough. So the employee is credited with 8 months of service there. And then because the employee returned within 12 months, the employee gets credit for the 5 months that the employee was severed from employment. So this employee would receive 13 months of service when the employee comes back. This is an employee who's furloughed and terminated employment, is rehired. The employee would receive 13 months of service. On the other hand, if the employee had not returned to service within the first 10 months of severance, in other words, within 12 months after the first day of the furlough, the employee would only be credited with 8 months of service. So that's 6 months actively employed and the 2 months of furlough, the employee would be credited with 8 months of service. Here's another example. This example deals with entry dates. So for the first example here, the employee worked 10 months, was furloughed for 9 consecutive months, and then returned to service. During the period of absence, the employee completed a year of service and passed the semi-annual entry date after satisfying the service requirement. So when this employee returns to service, the plan is required, this employee has met the service requirement and is required to be brought in on the applicable entry date. This next employee, employee C, after satisfying the minimum service requirements, is discharged before the next semi-annual entry date for the plan, and then returns to service before incurring a 1-year period of severance, but after the semi-annual entry date. Because this employee was eligible and passed the entry date, the employee should be allowed to participate as of the date of his or her return to service. The vesting rules, computing service is basically the same rules. You count service from the date the employee is employed. We're counting hours of service. You don't count hours if you're in the actual count method under a furlough unless the employee is entitled to payment for those hours under the furlough. You need to know, of course, for vesting, just as with eligibility, whether the plan uses the elapsed time method of crediting service. You need to look at the plan's forfeiture rules. If the plan may forfeit an employee's forfeitable account balance if the employee was cashed out when the employee terminated employment. So if the employee was laid off and was cashed out, then the pre-break service would not count. The employee's been cashed out and it's been the non-forfeitable, the forfeitable portion of the employee's account would have been forfeited. The plan may have a provision that if the account balance is at zero, if the vested account balance is zero, that the employee is deemed to be cashed out. But then upon rehire, the employee is deemed to have repaid the cash out. But if the employee was actually cashed out, the employee has the right to restore his vested amount or the vesting service by repaying the amount of the cash out. And then this wouldn't really be applicable for the COVID situation. Hopefully we don't have a situation where people lose 5 years or have 5 1-year breaks in service due to the COVID crisis. But a plan can disregard for purposes of vesting in a post break in service account service earned before 5 1-year breaks in service. Moving on a little bit from service crediting, I thought I'd just mention some relief that was provided in the CARES Act. Employees who were on furlough weren't earning compensation, and they probably weren't able to pay back if they had plan loans. They probably had difficulty repaying their plan loans. The CARES Act provided relief in the form of a 1-year delay in repayment of plan loans. So that is in place. Those employees would not necessarily, they wouldn't be in default for failure to pay back their plan loans for any plan loan payments due from March 27th through the end of this year. There also, the CARES Act provided for new in-service distributions called coronavirus-related distributions. If employees took those distributions and they returned to service, they're starting to earn, maybe they don't need the money, maybe they are in a position where they could return the amount of their coronavirus-related distribution back to the plan. The CARES Act provided that coronavirus-related distributions are treated basically like eligible rollover distributions. And if the participant has the ability to repay the coronavirus-related distribution that they received within 3 years, they can repay it back to a plan tax-free, as if they have received a distribution from a plan and rolled it over within 60 days. They now have 3 years to essentially roll over or roll back into the plan the amount of their coronavirus-related distribution. Okay, so that's a little bit on retirement plans, 401k plans. I'd like to switch gears now and talk about health and welfare benefit plans. In particular, with group health insurance and the importance of understanding whether the employee who is returning from a furlough or layoff is a continuing employee or can be treated as a new employee. And this is a really important concept for Affordable Care Act compliance. So an employee under the ACA regulations may be treated as a new employee and not a continuing employee if the employee performs no hours of service for a period of at least 13 weeks, or for an educational institution, 26 weeks. That's one alternative. The plan may otherwise provide what's called a rule of parity, where an employee who performs no hours of service during a period that is at least 4 weeks long and is also longer than the employee's immediately preceding period of employment up to 13 weeks. Now, if many of you have worked with me on drafting plan documents and amending plan documents for the Affordable Care Act, and my bias always shows through on this question. I always, present this option. We can either have the 13-week rule or the rule of parity. I prefer, and I think those of you who have worked with me, everyone unanimously has agreed, as I recall, the 13-week rule. So the 13-week rule gives you certainty that you have one rule that applies to all participants. If a person has been gone for 13 weeks or they haven't performed an hour of service for a period of 13 weeks, we can then treat that employee as a new employee and not as a continuing employee. The problem that I see with the rule of parity is that you then have a special rule for every rehired employee. You have to know the number of weeks that apply to that employee because it's based on the number of weeks the employee worked before the break-in service began. So the rule of parity, the 13-week rule can be a little bit more expensive for the employer, but the rule of parity is, from an administrative standpoint, I think a little bit more difficult to administer and could lead to errors. But again, just like with the 401k plan, you have to look at your plan document and know whether the plan uses the 13-week rule or the rule of parity, or look at your summary plan description and maybe described there. And if it's not, this is a good time to decide what rule you're going to apply and make the necessary plan amendments. So now the significance of whether someone is a continuing employee or a rehire. Under the ACA employer shared responsibility provisions and also the ACA rules regarding waiting periods, you can only impose a 3-month waiting period for participation in a group health plan once during an employee's period of coverage. So if the employee returns and is a continuing employee, the employee must be offered coverage as soon as administratively practicable following the resumption of service. And that's generally the first day of the month following the date the employee resumes services. So if the employee is a continuing employee, you cannot subject them to a waiting period again. If the employee can be treated as a rehire, if the employee's been gone for 13 weeks and didn't work an hour of service for 13 weeks, you could treat that employee as a rehire and impose the plan's waiting period. And again, you have to look at the plan document to see what the plan document provides regarding a waiting period. If the plan uses the monthly measurement method for identifying full-time employees, then employees who stopped working or were put on furlough, or certainly those who were laid off, if they weren't working the 30 hours per week on average per month, then those employees became eligible for COBRA. And now they're coming off of COBRA, and they would be made eligible again for the plan. If they're a new employee, you can make them go through the waiting period. If they're a continuing employee, they have to be brought immediately back into the plan. If the plan uses the look-back measurement method for identifying full-time employees, employees who are eligible for a furlough would remain eligible as long as they are still in the stability period, most likely the plan year that applies to your look-back period. They would remain eligible for health insurance even though they weren't working any hours of service during a furlough because they met the look-back measurement test. Laid-off employees, their employment relationship was severed, so they became eligible for COBRA. So it's really the laid-off employees who are coming back who you have to look at those employees and determine whether they meet the test for being a continuing employee, the 13-week rule or the rule of parity, or whether they may be treated as new hires under the plan's terms. And then, that's for this year. You also then have to look ahead to next year and the impact of a furlough or a layoff on eligibility for health insurance for next year. If your plan uses the monthly measurement method, it's just business as usual. If they work the 30 hours per week on average next year, they're going to continue to be eligible for health insurance. If the plan uses the look-back measurement method, however, Under the look-back measurement method, you're eligible for health insurance in a plan year or during a stability, it's called a stability period, if the employee met the look-back test that was applied before the plan year began. So under the look-back, you can use a look-back measurement period of up to 12 months and determine which employees work 30 hours per week on average during that look-back measurement period. Those who did work 30 hours per week on average during the look-back are then eligible going forward under the plan. Well, a layoff or a furlough will have reduced the number of hours that employees worked during the look-back measurement period. So it could be if your plan strictly uses the look-back measurement method for identifying employees who are eligible for coverage, the furlough could cause them to fail the look-back test for the next plan year. So you need to look at your plan document. You need to consider whether you would want to amend the plan document to carve out the furlough from the average, or otherwise draft the plan so that employees don't lose their eligibility in the 2021 plan year because of a furlough that occurred during the 2020 plan year. Briefly, I want to mention with cafeteria plans, a cafeteria plan may allow employees to retroactively elect coverage as of their first date of work, as of their hire date, if they make the election within 30 days. It's a special rule in the cafeteria plan regulations. But if you have that rule, the rule cannot apply to employees who terminate employment and are rehired within 30 days. So in most situations, those employees just continue in their elections that were in place prior to their break in service. So if someone is laid off and they return within 30 days, be mindful that if your plan has this special rule for retroactive elections back to the date of hire, know that that would not apply to someone who terminates employment and is rehired within 30 days. And then also for cafeteria plans, the IRS has granted relief for mid-year election changes. Generally, mid-year elections cannot be, or generally cafeteria plan elections have to remain in place for the entire plan year, with certain limited exceptions for mid-year election changes. Under Notice 2020-29, recognizing that employees are having financial difficulty, maybe they have different healthcare needs than they thought they had when they made their elections for the 2020 plan year. The IRS really opened up the ability of employees to make mid-year cafeteria plan elections. So under Notice 2020-29, with respect to health insurance, an employee may make a new election for health coverage. So if they declined health insurance, they can now elect it, or if they had coverage, they can now drop out as long as they certify that they're going to enroll in other health coverage. If they enrolled in the employer's bronze plan, but now they really realize they need the gold plan, they can switch plans mid-year. So it's giving employees ability to change their health insurance elections. They don't have to have any qualifying event or change in status to be eligible to make these mid-year elections. They can just make them for any reason during 2020 only. And then also with respect to health flexible spending arrangements and dependent care flexible spending arrangements, employees with those arrangements can also revoke existing elections, reduce the amount of contributions during the plan year, and basically change their flexible spending arrangement elections. We recommend to clients that if you're going to allow changes in flexible spending arrangement elections, that you don't allow employees to reduce their election below the amount that they've already received reimbursements as of the date of the election, because otherwise the employer is going to be left without the ability to recover the funding from the employee's contributions for amounts that the employee already received through reimbursements under the account. And with all of these changes, the IRS, the notice makes clear, you're not required to adopt any of them, and you can restrict them as you wish under your plan. The plan will have to be amended for these changes. There's an extended, it's in the 2021 that you have to amend the plan documents. The plans, however, will have to be amended for these changes. But you have flexibility as an employer to decide the extent to which you will allow these election changes and the extent to which you're going to limit them. Several clients have chosen only to allow changes to flexible spending arrangements and not allow the health insurance changes. It's really up to you. Notice 2020-29 also extended the grace period for using prior year funds for expenses occurred in the current year through the end of 2020. And the health FSA carryover amount is being increased from $500 to $550, and going forward it will be indexed and related to the annual flexible spending arrangement contribution limit. The amount of the health flexible spending arrangement carryover is going to be linked to the amount employees can contribute to their accounts. And again, the deadline for these amendments is at the end of 2021. And with respect to dependent care, employees are having unique dependent care issues this year with COVID-19. Under the FFCRA, there is guaranteed paid leave for employees if their children's daycare center or school is closed. There is guaranteed leave and guaranteed paid leave for employees to stay home and care for their children. And then with the changes to the cafeteria plan rules for this year only for dependent care, employees do not need the change in status events that they used to need or normally need to make a dependent care FSA election change. They are now free to make changes to the dependent care accounts under the IRS guidance, and to the extent that the employer wishes to allow those changes. And so at this point, if there are any questions, we can address them now or at the end of the program. I've run a couple minutes over, but I'm happy to take a look at some questions. Well, if there are no questions, I think hopefully I'm doing this right. I'll turn this over to Marc and Marie.
Thank you, Brydon. I appreciate it. So this portion of the presentation, Marie and I will discuss relief that is provided by statutory changes that were made by Congress earlier this year. And Brydon, if you advance to the next slide. So Congress has passed 3 pieces of legislation that have affected a variety of different benefit arrangements in response to the coronavirus pandemic. And in reverse order of how they were adopted, but in order of which is most significant with respect to plan provisions, the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act, was passed, and that was the end of March. The Families First Coronavirus Response Act was passed in mid or early March, and then the Coronavirus Preparedness and Response Supplemental Appropriations Act was adopted, I think, at the beginning of March. It might have been the end of February. Since that time, the Departments of Labor and the Departments of Treasury have issued plenty of guidance on the provisions of the CARES Act and the Family First Act. And we'll be discussing those changes in the future slides. The CARES Act allows for a variety of relief for participants. The first is coronavirus-related distributions. There are some increased loan provisions and provisions related to loan deferrals, and also relief from required minimum distributions. So the first of the major changes for retirement plans is the coronavirus-related distributions, which are also known as CRDs. The next two, this change and the next 2 changes that we're going to discuss are basically discretionary changes. Employers may decide to adopt these changes, may have decided to adopt these changes, or they may have decided not to allow the changes, but if they do allow them, they can be of great value to participants. So with respect to the coronavirus-related distributions, this distribution is probably the most helpful of the changes for 401k plan participants if they are in fact affected individuals. Under the CRDs, an affected individual is permitted to take a distribution up to $100,000 or if less, 100% of the vested account balance. And these distributions can take effect beginning in January of 2020, and taken before December 31st, 2020. The distributions are not subject to the mandatory 20% withholding that normally applies to distributions from a qualified plan. The distributions are included in taxable income, but not completely in the first year, but rather ratably over 3 years. So if somebody took $90,000 distribution, then it would be $30,000 per year over a 3-year period. The CRDs are also not subject to the 10% excise tax that applies to early distributions. And those distributions under a 401k plan or other qualified plan would be distributions to an individual who had not yet reached age 59 and a half. So if you can take this distribution and you're not going to have withdrawal liability, additional 10% penalty, that makes it easier for participants to decide to take the distribution. So in that way, it's different from hardship distributions that might otherwise be available in a plan. The amount of the CRD can be recontributed. As Brydon mentioned in this last section, if the participant takes this distribution because, say, they're furloughed and they're encountering economic hardship, if they come back to work and they no longer have the financial drag, they may decide to recontribute that to either the plan from which they took the distribution or any other qualified plan or an IRA, provided the amount is returned to the plan or to a plan within 3 years, in which case the amount of tax that had been paid would then be refundable through the participant's tax returns. So the CRDs are really helpful, but they're only available to affected individuals. And such individuals are persons who've been diagnosed with COVID or who have a spouse or dependent who is also has been diagnosed, or who are experiencing financial hardship because of quarantine or other qualifying factors. These factors include a reduction of pay, a rescission of a job offer, a delay in the start date with respect to the individual, as well as adverse financial consequences to the individual arising from the impact of COVID or to the individual's spouse or another member of the individual's household. And as I said at the beginning, before we started on this slide, this one is actually useful in a variety of situations. One situation that we've worked with some clients is their plan provides that when the participant ceases employment, if they have an outstanding loan, the loan is due immediately. 100% of the loan is due immediately. And that's can be very difficult for people because all of a sudden, if they don't pay off the loan, then the loan is defaulted. They'll have a tax due on the loan when taxes are due the following year. And they also, if they haven't reached age 59 and a half, would be subject to a 10% excise tax. However, if they're an eligible affected individual who is eligible for a CRD and the plan permits it, they may be able to take a distribution in the amount of the outstanding loan balance and pay off the loan when they cease employment and therefore avoid the negative tax consequences. So let's go on to the next slide, Brydon. Okay, so there are loan provisions that apply from the CARES Act. And the first one has to do with the loans that already are provided under the plan. If the plan's not providing loans and if the employer doesn't want to provide loans, then these provisions are not available. But if the plan has loans and the plan sponsor decides to go forward with the enhanced loan provisions, the employer can allow employees to take greater loans. Typically, the most an employee can take in a loan from a plan is 50% of the employee's vested account balance, or if less, $50,000. Under the enhanced loan provisions that the CARES Act provided, employees can take up to $100,000 or 100% of the participant's vested account balance, if less. However, these provisions were only available for the first 180 days after the date of enactment. And in this case, that means the date of enactment was March 27th, and the end of the 180-day period is September 23rd, which was yesterday. So if you allowed loan provisions, enhanced loans through yesterday, you need to stop that because they're no longer available at this point. Many of the other changes in the CARES Act continue through the end of the year, but this one has a cutoff date, and the cutoff date was yesterday. Also, the CARES Act provided for a deferral of loan payments. And the statutory provision made it clear that if a payment is due, any payment is due on an outstanding loan that falls between March 27th and the end of December, then the payment would be suspended for 1 year. But the guidance from the IRS made it clear that they didn't intend that every outstanding loan payment had to stop, that it was only a permissive provision, and that if there was a need for the loans to stop, they could stop. Generally, loans have to follow an amortization schedule, and you have to make payments typically every pay period or every month. And if you suspended the loans, they would end up in default. But in this case, there's grace in the act that would allow you to suspend the loan, that the suspension would last for 1 year. When repayments begin, then the amortization schedule is extended to take into account the delay. And if there is interest, and there probably should be interest that accrued during that period, the interest would also be included in the amount that's due on each repayment after the end of the delay. Brydon, let's go to the next slide. Wait, go back, sorry. I thought that there were 2 slides here. So minimum distributions. Generally, qualified plans are required to make minimum distributions to individuals who have reached age 70 and are no longer employed by the sponsor of the plan or one of the participating employers in the plan. And these distributions have to meet certain requirements, and they happen either annually or periodically throughout the year. This year, in the CARES Act, Congress permitted a waiver, but only for calendar year 2020. This also occurred back in 2009 when we had the economic downturn. Statute Congress allowed for a waiver of minimum distributions in that year. And this waiver actually applies in addition to defined contribution plans, qualified defined contribution plans, but also IRAs. The waiver does not apply to pension plans. So if somebody's already receiving a monthly annuity, they got to keep receiving the monthly annuity under the pension plan. Over the summer, Congress allowed for people to roll over any minimum distribution that they received but didn't want to receive earlier in the year. But that period, 60-day period for rollover, has ended. Waivers only apply for 2020 and will not apply for future calendar years unless the statute is changed. Okay, let's go forward to the next slide. I think it's up for Marie.
It is. Thank you, Mark. We can go to slide 30, Brydon. Thank you very much. Hello, everyone. I'm going to talk to you all about the group health plans coronavirus relief. As Mark had mentioned, there were 3 legislation packets and then various IRS notices and DOL notices, and you name it, the gambit. So Brydon already mentioned the first one. This is group health plan extensions of timeframes, election, and due dates, and he mentioned IRS Notice 2020-29. But I wanted to kind of take a step back for a moment, because what I noticed when reviewing all of the legislation was there was a very particular goal of providing access to healthcare, eliminating barriers for testing for treating COVID, and avoiding financial disincentives that impeded testing. And so the primary goal was the provision of this access of healthcare and the ability for Americans to focus on the public health and doing what's best for everyone. So, you know, these cafeteria plan mid-year elections, all of these things were really to help everyone make better financial decisions, as well as promote positive action. So the second one, extension of timeframes for actions related to notices and disclosures to be provided by ERISA plans. As you know, ERISA plans are required to provide various notices and disclosures, and timeliness is of the utmost importance in many of these notices. But the CARES Act, ERISA Notice 2020-01 allowed for some discretion and a good faith kind of argument that as long as you had good faith and you did not make these timely, you would not have an ERISA violation. So again, extending some grace to people. The third on my list, the CARES Act allows certain over-the-counter medical products to be included as qualified medical expenses for medicines in your FSA without a prescription. And actually, notably, not only is this over-the-counter, you know, let's just say cold medicine, but also menstrual care products, which is something that has been talked about in the past. One of the things, aside from cafeteria plan mid-year elections, was the HSA that also Brydon had mentioned on slides 21 and 22, which were pretty notable. So let's go ahead and go to slide 31, please. So while the FFRCA was requiring group health plans to cover COVID testing, the CARES Act was looking forward and requiring and instructed the Secretary of Labor and Treasury to require health plans to cover, without cost sharing, qualifying COVID preventative services. So while we don't yet have a vaccine, hopefully we will soon, this allows, and the goal, and the next one, the high deductible healthcare plans, is for providing vaccines and making it more available, again, increased access to healthcare. So why this is important here for the high deductible plans is they wanted to make it so that way you could get testing for and treatment for COVID without a deductible, and this could negatively affect the status of a health savings eligible plan. And they wanted to make it clear in this IRS Notice 2020-15 that that was not to happen, with the goal of, you know, encouraging people to become tested and getting treated. Same with this remote care provision in the CARES Act. Again, incentivizing behavior of allowing people to see their physician remotely and not providing a deductible for telecare and other remote care services. Again, keeping people home and encouraging the public health. Please proceed to the next slide. Thank you. So during my research for this presentation, I came across a really fascinating fact, and it was a study that CNBC reported on last year, and it said that 90% of the American population, when surveyed, said that they generally come to work sick. That's a big deal. And the question was why? Why do they do that? And it's become an acceptable and almost expected from employers. They pressure their employees to come in sick, and they don't have enough sick days. So Congress knew this and put these provisions in place. So the FFRCA has the emergency sick leave, which requires applicable employers to provide certain paid sick leave and family and medical leave to qualifying COVID-19 reasons. So how much leave are we talking about? Full-time, 80 hours paid sick leave. Part-time, it's supposed to be an average hours worked over 2 weeks. This doesn't carry over, ends at the end of the year. Your employer can't require you to use your other PTO. So say they have you already have sick leave. No, you need to use this sick leave first that's provided in this provision, and then you would use your other benefits. You can't require them to say use their vacation time. Let's see. Next is the family and medical leave that employers must provide up to 12 weeks of expanded FMLA for an employee, and about 10 weeks of that is paid at 2/3 pay. And that's pretty significant. This, both of these extend to the end of the year, and both of these, the employer is incentivized because they are being given a dollar-for-dollar payroll tax credit for the employers. And by incentivizing the employer, the hope is that they'll incentivize employees to make smart decisions, stay home when they're sick, not have to worry about whether they're going to get paid and whether they can afford to stay home. So again, driving responsible behavior by eliminating barriers. My favorite one is the last one, student loan assistance. So for a while now, people have been wanting something like this to happen. And currently an employer, for this provision to apply, needs to have an educational assistance program, which can be created under Section 127. And what it allows is employers to pay up to $5,250 towards an employee's student loans on a tax-free basis. This is key. So currently they can either give it directly to the lender or they can give it to the employee. But this is the first time, at least in my knowledge, where you could pay towards a student loan on a tax-free basis. So this unfortunately only is to the end of the year, but the hope is that it will be extended beyond 2020. Next slide, please. Thank you. All right, so COVID-19 leave program donations. Not a big fan of this one, but I don't find that it incentivizes the proper behavior, but some people may disagree. People tend to like leave donation programs for obvious reasons. They want to help out their fellow colleagues, very important. But in this case, if you make a donation of your leave, it's a tax-favored cash payment and the fact that you're not recognizing this into income, but you also don't get a deduction. Your employer gets a deduction. So I don't know that it incentivizes unless it's a goodwill behavior, but still an important one to note nonetheless. A better one is the Qualified Disaster Relief Program, which is typically provided under Code Section 139 for these type of emergency declarations, and this COVID situation does count as one of those. This is helpful to pay reasonable expenses of employees, and the good thing is it's excludable for the employee to recognize an income and deductible by the employer, so this makes it better for everybody. And these kind of reasonable expenses could include, lodging for, let's say, a healthcare worker that can't go home because they've contracted COVID and they don't want to expose their family, or meal delivery, or they need to buy hand sanitizer. And the interesting thing is, unlike most monies received by employees, there's no substantiation requirements. So you could give a lump sum or expense by expense, to cover the expenses of the employee. But as long as they're reasonable expenses, you don't have to substantiate this. So this is pretty interesting.
So Marie, this is Marc. Yes. I just wanted to throw out that I had a client that actually adopted this relief to help parents who had children who their schools were closed and they needed to hire childcare.
Oh, wow, that's great.
As opposed to using the dependent care account or a dependent care program, they just use the disaster relief program in order to help select, not everybody who has dependents, but people who had children who were affected by closed schools.
Yeah, and this is definitely an option for this qualified disaster relief. Thank you, Marc, for noting that. And the last on my slide is another kind of incentive for people is the CARES Act increased the charitable contribution deductions for cash contributions by individuals and for corporations. And the goal here is an influx of cash into public charities because the public charities are able to help individuals in different scenarios. And this one's pretty significant because typically your income, you can only give up to a certain amount of your AGI. With this, you can give 100% of your AGI, have no taxable income whatsoever for the year. So let's say you are a partner in a partnership and your partnership makes a donation of a lot of money. And then you have your K-1 and on your tax return, that flows through. So you could have 100% of your taxable income wiped out. That is very significant just for this year. Now, this is also for corporations, so typically you can only have a 10% of your taxable income, but now it's up to 25% with this one. Food inventory, if you donate food inventory, before it was 15%, now it's 25%. So they're really trying to encourage charitable deductions, and they're really trying to incentivize those donors. So that is the end of my slides. I believe next we are going on to Nona. Take it away, Nona.
All right. Hi, everyone. My presentation today is going to be on restricted stock units, which is a form of equity-based compensation. I'm not tied in to the nautical theme, but most definitely the 2020 theme. There are a couple of new developments that pertain specifically to restricted stock units, and that's not such a common I guess, subject for discussion. So I thought it was notable and really wanted to share it today. RSUs are, for those of you with stock incentive plans, there's something that you may or may not use, but they are an increasingly common form of equity compensation. And they, actually hit the news this year and last year as well. In the context both of a lawsuit, which we'll discuss, and then just sort of descriptions of high-profile people receiving compensation in the form of RSUs, and what both of those cases told, I guess both of those news items told me is that there's not always maybe a full understanding of exactly how these equity awards work. And there are associated tax consequences that, while they are, pretty in the weeds and sort of boring, do have practical impact. So I thought it would be worth talking about today. Next slide. Okay, so one of the newsworthy items regarding RSUs this year was a complaint filed against Uber. And this was in the context of RSUs that employees held prior to Uber's IPO, and what occurred in terms of settling, the timing of settling those awards in the context of an IPO. So let's back up and describe just briefly what RSUs are and how they are settled to give some color to what these complaints by employees could be about. So a restricted stock unit, as opposed to a restricted stock award, is a promise to deliver cash or stock in the future. It's not a grant of stock on day one. So most restricted stock units provide, subject to continued service, maybe attainment of performance objectives, that stock will be delivered at a specified time, or perhaps cash equal to the stock value at that specified time. That's in contrast to a restricted stock award where stock is issued on day one. Taxation and withholding on restricted stock units is always relevant because there's withholding that applies to any type of compensation paid to a common law employee. In this case, the restricted stock unit apparently had provided for settlement 6 months after the IPO. That was to align with the end of the lockup period. There was a decision made to settle earlier, coinciding with the IPO. That in turn had an effect on the income received, the amount of income received by the participants, and therefore their tax obligation. So without going into too much detail about the claims, I will note that they are state law claims. They're not, these are not ERISA plans. So really the focus was on state law challenges to this action. But the bottom line is the settlement date of an RSU is going to affect, how much tax somebody owes. And they're still, they still may be holding stock that is changing in value, but has a tax obligation locked in as of the settlement date. So that's something to keep in mind. I will also say that one of the claims in this case, I think ultimately pertain to what the agreement allowed the company to do, and changes that were made and disclosed to participants by the company, but whether those changes were permitted, mandated, or inconsistent with the terms of the original agreement. So it's always good to, look at what impact the drafting of an agreement might have, but also if you're getting ready to change the agreement in any way, understand the impact that may occur and carefully review the original agreement before making amendments. Next slide, please. I think we can go on to the next slide. All I will say about the prior is that you can read it when you receive the presentation, but that there was some confusion that I took from tweets and almost silly news stories, but about really how an RSU works. So I think just a basic understanding, like we've discussed today, and through a read of your documents is useful. Okay, the GLAM part. I could not let this new acronym pass without adding it to my PowerPoint. I thought it was great. But this is a Office of Chief Counsel advice memorandum that really gets into a lot of detail in conjunction with an IRM, a procedural update that was issued shortly thereafter, both in May of this year, about exactly when tax liability is determined, when payments have to be when taxes have to be withheld, and very specifically when taxes have to be deposited without running afoul of just the general tax deposit rules that apply to all types of compensation that change when total compensation or payroll hits a certain level, and the timing for deposit may become quicker. So don't want to say too much more here. I know we want to have time for the remaining presentation, but that if there are any questions regarding the implementation of settlement of RSUs or stock options and how that affects both withholding, mechanics of withholding, or timing of deposit, I'm glad to answer any questions offline. And the advice memorandum and the procedural update together are, again, in the weeds, but fairly instructive, I would say. I think that, let's go to the next slide, Brydon. But oh, yes, and the final caveat, because whenever 409A is lurking around the corner, I like to note it that RSUs, unlike restricted stock, so this is another important distinction between the two types of awards. RSUs potentially are subject to Internal Revenue Code Section 409A. Doesn't mean that it's difficult to structure them to comply with 409A. It's not, but it does have to be taken into account in the way that both vesting measures and settlement timing is provided for in the agreement. So that's one other, just general information point about RSUs that's important. I think that's it. Okay.
Thank you, Nona. I'm glad to have that lawyerly caveat at the end of that. As always, anything that looks like it's going to have a 409A implication, I'm going to come talk to you. So this last section, we're going to cover some issues regarding fiduciary duties. Brydon, if you'll advance the slide one more. So just as a quick overview, we're going to talk about ERISA's fiduciary duties that are applicable to plan fiduciaries. We're going to focus on the duty to monitor and look at a Supreme Court case related to that. Pay attention to how market changes may require changes in investment strategies, look at the importance of procedural prudence, particularly in this volatile time period, and finally, talk briefly about participant education and what fiduciaries may want to do. So Brydon, let's go ahead with the next one. So ERISA actually sets out that fiduciaries of the plan are subject to certain duties as they act in their fiduciary capacity with respect to the plan. So first you got to figure out, are you a fiduciary? And normally when we do a presentation on fiduciary duties and who's a fiduciary, et cetera, we could go on for an hour or more. But we have, it looks like maybe 15 minutes at the most with questions. So I'm gonna skip the detailed description of who's a fiduciary, but generally fiduciaries are either individuals or entities described in the plan or people who have had fiduciary duties delegated to them by fiduciaries described in the plan. It's important to figure out who is the fiduciary in the plan. The plan document generally would describe who is the fiduciary. It's often the plan sponsor. It may also be a committee, an investment committee frequently, if designated in the plan as the fiduciary, perhaps for management and control of plan assets. It might be that the plan sponsor is designated a certain group for administration of the plan, eligibility provisions, loan provisions, et cetera, other plan administrative functions. But anytime an individual exercises discretionary control over plan assets or plan administration, they're acting in a fiduciary capacity. And in so doing, they need to act in a way consistent with ERISA's fiduciary duties. So the first duty is the duty of loyalty. And this is basic, and it comes, all of these duties have their origin in the law of trust that pre-existed ERISA when it was passed. And the duty of loyalty is in addition to it being in ERISA, it's right up there in the qualified plan rules in Code Section 401A. And it says that the plan fiduciaries must act solely and exclusively in the best interest of the plan participants and their beneficiaries. So when you're thinking about acting with your fiduciary hat on, you have to act in the best interest of plan participants and beneficiaries. If you're acting not as the fiduciary, but maybe as the plan sponsor, decisions about how to amend the plan are not subject to this requirement. But if you're acting as a fiduciary, you need to keep this in mind. In addition to that, in the duty of loyalty, it's also the duty to defray reasonable expenses in administering the plan. I'm sorry. One thing to keep in mind is that the duty of loyalty to the plan may conflict with what you think is in the best interest of the company. But if you're acting as the fiduciary, you can't think about what's in the best interest of the company. You have to act in the best interest of the plan participants and beneficiaries. The next duty is the duty of care, which is basically that the fiduciary must be prudent. When the fiduciary acts to act in a prudent process, and it's more about the process and not so much about the end result. But the fiduciary must act with the care, skill, prudence, and diligence under the circumstances. So what's happening right now, then prevailing, that the prudent person acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of like character and with like aims. It's a lot of words to say you got to act as a prudent person who knows what you're doing. It's not the reasonable person on the street, but somebody who's familiar with, if you're acting as a investment fiduciary, a person who is familiar with plan investments and under the circumstances at the time that you're taking the action. So good faith is not enough to meet the standard of care for an ERISA fiduciary's duty of prudence. Let's go to the next slide. Duty of diversity. Basically, plan fiduciaries have to diversify the investments of the plan to minimize risk of investment losses. The statute says, unless it's not prudent to do so. If there's some reason to believe that 100% of the investments in this particular fund would be the most prudent thing to do, then you get a pass. But I don't know very many fiduciaries who could even imagine what that would be like. And then because we're diversifying assets and we're often thinking about defined contribution plans that allow participants to direct their investments, the investment options that you have in the plan have to have enough diversity to allow the participants, as they manage their own investments, to minimize the risk of losses. So that's also important. Finally, the duty to follow the plan document. The document tells us what are the terms, how the plan is to be administered, who's going to be eligible, when they're eligible, how we're going to count hours of service, etc. If you're administering a plan, you need to follow the plan document. And in addition, the plan document will identify who are the fiduciaries and what are their roles. And often that can become a problem when someone has been designated as the person who's going to take on a responsibility, but the plan doesn't actually reflect that designation. And so it's important to be aware of what your plan says about who's the fiduciary and what their roles are and what their authority is and when they are allowed to delegate authority and when they're not. So let's switch to the next slide. Before we jump into this one, I do want to say that an important piece of ERISA fiduciary duties is that fiduciaries who breach their duties can be held liable, which is what all these cases that we're going to talk about are hinge on. They could be held liable for breaching their duty. But fiduciaries that are responsible for a plan that allows participants to direct their investments can be relieved of liability in certain circumstances to the extent that the participants have discretion to exercise their investment rights and to change their investments and follow what are called ERISA 404C requirements. Not going to get into that, but the rest of these slides have to do with, at least this case that's coming up, has to do with plan investments in a plan where the participants were allowed to direct their investments, and they're claiming that the fiduciaries breached their fiduciary duty with respect to the investments that were in the plan and therefore charged excessive fees. So the first case we're going to talk about is the Supreme Court case of Tibble v. Edison. And this case goes all the way back. It starts soon after the economic downturn in 2008. And this plan, Edison 401k savings plan, experienced significant losses as the markets decreased. Participants lost a lot of money in their 401k accounts and wanted to hold the fiduciaries of the plan liable. And so they looked at the investments and they could see that the plan had locked in a group of investments back in 1999, and then a second group of investments, I think in 2003 or 2004. And they bring suit claiming that the investments were no longer prudent, and therefore the fiduciaries had breached their duty of care and should be liable. And the district court, the plaintiffs in the case said they should be liable. The defendant said these are time bar claims, at least with respect to the investments that were selected back in 1999, because now we're past the ERISA 6-year statute of limitations. And so with respect to those claims are time barred. And the Ninth Circuit agreed with this ruling. Let's go ahead, Brydon. The Supreme Court did not agree with this ruling. The Supreme Court in 2015 had a unanimous ruling, which is absolutely noteworthy. And they overturned the Ninth Circuit's decision based on the statute of limitations. And what they said was that, yes, the initial decision cannot be reviewed. We can't go back to 1999 and decide whether it was prudent in 1999, whether that investment and the fees associated with that investment can be in the plan. But they have an ongoing duty of care that requires them to monitor the investments. Just because it was a great investment in 1999 for you to invest in Enron, it's not going to be so great in 2008 to have that investment in your plan, especially since Enron by that point had gone bankrupt. But these weren't Enron investments, but any investments have to be monitored, and the duty of monitoring goes back. The Supreme Court said they looked back and they said that the duty to monitor comes out of the law of trust, and therefore ERISA fiduciaries are imposed this duty to continue to monitor investments, and as long as the plaintiffs have alleged that the breach of fiduciary duties has an ongoing and continuing problem, then the claim is not going to be time barred by the 6-year statute of limitations. And thus the court ruled that the fiduciaries should conduct a regular review of its investments. So the duty to monitor the investments in the plan continues even if you've had the investment in the plan longer than the statute of limitations. Let's go forward, Brydon. Sometimes defined benefit plans actually will de-risk. When defined benefit plans have a trust that's not controlled by the participants, but by the fiduciaries, and they'll de-risk their plans in the middle of market volatility. But if times change, if situations change, you need to go back and review that. Again, part of this duty to monitor. This past year, let's go to the next slide, Brydon. There's a Supreme Court case, Old B U.S. Bank, that dealt with a defined benefit pension plan. And the defined under the case, the participants claimed that the fiduciaries breached their duty because they allowed huge losses. In fact, in 2008, this overfunded plan of this bank had losses in excess of $1.1 billion. And they alleged that it was imprudent investments by the plan fiduciaries in 2007 through 2010 that resulted in losses of $750 million. In the course of this litigation, the plan the plan sponsor increased the funding by $339 million to bring the plan back to an overfunded status. But the district court said that the participants didn't have standing because they were alleging a breach, but they didn't really have an actual interest in this. They were getting their benefits and they were not affected by the economic loss. The Eighth Circuit affirmed. Let's go to the next slide. So the Supreme Court affirmed the judgment of the Eighth Circuit, and you can see the details in the slide. I know I'm running out of time, so I just want to get to the significant point. The Supreme Court said, as a matter of constitutional law, they didn't have standing because at the end of the day, whether they won the case or they lost the case, the participants were still going to get the same monthly benefits they already were slated to receive, and it wouldn't change. And then there was an issue of whether or not, if there were allegations that said, well wait, if it was so grossly mismanaged, perhaps the plan could then be terminated and taken over by the PBGC because it was so grossly underfunded. But the court said, well, the PBGC's insurance is there for this purpose, which may or may not be sufficient. The real important point here, though, I think for us today is to note that economic situations change. This bank in 2007, at the beginning of 2007, was 100% invested in equities. 40% of its assets were invested in funds of its affiliate. And they didn't make any changes in 2007 and in 2008, and they have $1 billion worth of losses. Changes sometimes are necessary as you're exercising your duty of prudence. They ended up not being liable per the Supreme Court, but we need to, as individuals who are plan fiduciaries, need to pay attention to the current economic situation, the current market situation, maybe make adjustments, and then if situations change again, return to those previous decisions and determine whether time has changed and you need to cease de-risking or move investments in another way. Let's go to the next slide. This one really relates to, I think, our current situation because it's a difficult time for all kinds of employers. It's a difficult time because we have employees working from home. We have employees who've returned to work, but working in very different situations than they previously did. We may have fewer people working. And it's easy to allow or to think you can allow certain processes and procedures to slip. But really the purpose of this case, and we're not going to review it, you can look through the slides. This case was also a breach of fiduciary duty from a 401k plan. And the participants claimed that the fiduciaries had failed to act prudently because they were charged too high fees with respect to their plan investments. But the court, step by step, looked at what the committee did, and the court determined the committee followed a prudent process, that it followed its meeting schedule, that they had productive meetings, that the meetings were well documented, that they selected investments. Go ahead to the next slide, Brydon. That the committee reviewed a variety of information and that they consulted with investment advisors and legal experts. Let's go to the next slide. And the court just looked at it and said, you know, it's not up to the person looking back at it to say, well, they could have made a better decision. It was the process at the time prudent that they followed? And were they monitoring the investments in accordance with the process that they'd established, and have they documented that? And the court concluded they had. And as a result, they relieved of liability in this situation. So let's go to one further slide. So also, I think fiduciaries need to pay attention to what's going on with participants, at least with respect to participants who are in plans where they're monitoring and they're responsible for their own investments. I can't tell you how many articles I saw that came out in March and in April, and the advice from all kinds of investment advisors were don't panic and hold on to your position. I also saw articles that said when the market's down, now's the time to buy. I think a lot of participants are in that situation trying to figure out what they're going to do. Other plan participants may be really afraid by what's going on in the markets and what's unknown about the future, and may decide they want to move toward more stable investments or cash equivalents in the plan. And it may be helpful for plan fiduciaries to consider participant education at this time. So let's flip to the last slide. So just as a really quick overview of types of participant education that you can have, there's non-fiduciary participant education that the DOL has prescribed, that you can give participants information about the plan. You can give them generalized financial information and investment information that's not specific to the plan. You can provide asset allocation models that aren't specific to the participant, and also interactive models. You know, if you have a website that allows them to go in and say, if I increase my investment in this, the potential return might be a retirement benefit of X at such and such a time. Those are all deemed non-fiduciary related. Some plan sponsors provide fiduciary education, which includes investment advice to participants, where they might meet with an investment advisor who doesn't specifically tell them you should do X, but talks to them about the plan investments and gives advice about what they think might be a prudent choice, but that they don't actually exercise control. They don't change the investments for the participants' accounts. The third kind of participant investment advice is really investment management, where the participants sign over control of their accounts and allow an investment manager to select the investments for them among the investments that are offered under the plan. That is a discretionary type of investment advice and has a higher threshold of liability associated with it. And then also some employers are looking at broad-based financial wellness services. So in addition to advice regarding the investments and plans, helping participants look holistically at all of their student loan debt, housing debt, any other debt that they may carry, as well as other investments they have outside the plan and Social Security. So that's a quick run through. I think we are close to the end of our time. If there are any questions, you can put them into the Q&A box and we will answer them as we have time. But I think we're at 12:30, so I think we have hit the end of the time. Unfortunately, we have run out of time, so I think if you have questions, you can go ahead and send them to us and we will respond accordingly. Thank you for joining us today. Please look forward to an email later this afternoon from Williams-Mullen with information about SHRM credits as well as copies of the presentation. And please contact us if you have any additional questions or any thoughts about future presentations that we could give. And stay safe. And thank you for being with us.